Hello everyone. In Chapter 2, you will see underlying assumptions which serve as foundations for many accounting measurements or judgments. There are universal assumptions such as time period, separate entity, and unit of measure. And there are also entity-specific assumptions such as the proprietary concept and the stable currency concept. The stable currency concept basically assumes that values or dollars listed on financial statements are always the same or stable. In other words, financial statements do not differentiate between dollars of different years. But that's not correct, right? There's inflation to say the least. For example, the value of assets purchased with $100 2 decades ago is not the same now. It's probably well over $100. The value of that capital or asset may at least have been affected by inflation, right? So that's why there are alternative approaches to capital maintenance. And the definition of capital maintenance is operating while preserving a company's capital investment. Here we have an example where we'll calculate profit under alternative capital maintenance concepts or approaches. And the given is Vivo Instruments Inc. is a retailer of musical instruments in North America. In 2020, the company sold $21,000 worth of instruments, which had originally cost $15,000. Inflation during the period was 4%. The instruments could be replaced for $18,500 from the company's long-term supplier. Assuming that there are no other costs of doing business, calculate a measure of accounting income consistent with nominal dollar financial capital maintenance, constant dollar financial capital maintenance, and physical capital maintenance in nominal dollars. Alright, so let's do the first one here. So we'll calculate profit under nominal dollar financial capital maintenance. So the first one here. And here we report profits after recovering historical costs in nominal dollars. So we'll just consider this cost, $15,000, in this profit calculation. So nominal dollar financial capital maintenance. Okay, so profit is 21,000 minus 15,000. So in this case, profit is $6,000. All right. And the second one, which is constant dollar financial capital maintenance, we report profits after considering inflation. So it's similar to the first one, but we have to consider inflation. That 4% inflation has to be considered. So let's put it here. Constant dollar financial capital maintenance. Profit is 21,000 minus 15,000. We are considering inflation here, 4% inflation, and this is 15 multiplied by this, so 50. So 4%, so $600, so $15,600 is this component here. So 21,000 minus 15,600 should give us 5,400. Alright, and the third one, physical capital maintenance in nominal dollars. So here, the company ensures that it keeps enough capital to replace assets or inventory, and only after then it reports profit. So the way it looks is, let me put it here, physical capital maintenance. Profit is 21,000 it says here that inventory could be replaced for basically $18,500. So those instruments that were sold, that inventory can be replaced for $18,500 in the market. So we put it here, 1,500, and here we have, I think, $2,500. Alright, so here we calculated profits under those three alternative approaches. And here, one more thing to keep in mind is that, you might be wondering which approaches gives, more flexibility to the company in terms of purchasing inventory or replacing inventory. So to do that, here let's look at cash. So imagine this company, just paid out its profit as dividends to its shareholders, right? And it's a very simple business. There's only sales and this cost, and nothing else, right? So it paid its profits to its shareholders. So let's calculate cash here after paying out those dividends. So in the first case, remaining cash is 21,000 minus 6,000, right? As you can see there, it's 15,000. The second one, cash here again, 21,000 minus $5,400, which is 15,600. Alright, and the third approach gives us 21,000 minus 2,500. It gives us $18,500 of cash that can be used to replace inventory. So it looks like only under the third approach here, under the physical capital maintenance approach, the company can replace its inventory, right? For the other two approaches, it doesn't have enough cash to go and buy inventory or replace that inventory that it sold in 2020. So only this third approach gives us enough cash to replace inventory. So I hope this example illustrates an application of alternative capital maintenance concepts. Thank you.